So, you've been putting money into an SIP every month. Maybe 2,000 rupees, maybe 5,000. Your app is showing you a return of, let's say, 14%, and you're feeling pretty good about that. But here's a question I want you to sit with for a second. Do you actually know what this 14% means? What if I told you that this 14% might be a lie? Today on Invest Angle, we're going to look at the real math your app hides from you. A small percentage gap that could actually cost you several lakhs over the next 10 years. Let's start with the basics. A systematic investment plan, or SIP, is simply a fixed amount of money invested automatically into a mutual fund every month. Think of a mutual fund like a basket of companies. So, your 5,000 rupees monthly investment buys you a slice of multiple companies like Infosys, Reliance, HDFC, and TCS, for example. This is great because a fund manager does the heavy lifting for you. And because your money is spread across many companies, you aren't completely ruined if one specific stock crashes. Most people wait for a market crash to buy, but as an SIP investor, you use something called Rupee Cost Averaging. Think of it like a smart shopping strategy. Because you commit a fixed 5,000 rupees every month, you're forced to stock up when prices are low, which naturally brings down the average price you pay for your entire portfolio over time. Look at the table. In January, at 50 rupees a unit, you got 100 units. But look at March, the market crashed to 33 rupees. While others panicked, your same 5,000 rupees automatically bagged you 151 units. Now you might be thinking, wait, I'm also buying fewer units when the market is high. Or if the price starts low initially, wouldn't a lump sum be better? And the honest answer is, you are right. If you knew for a fact that today was the absolute lowest the market would ever be, you should invest every rupee you have right now. But here is the reality of the market. Nobody knows the lowest point. Markets are moody. They breathe up and down. Rupee cost averaging is your insurance against that moodiness. It ensures you never miss a sale at the bottom, lowering your average cost, like the 40.8 rupees you see here, without the stress of trying to time the perfect entry. For most of us, that peace of mind is what actually keeps us invested for the long term. All right, let's assume that you've been investing through an SIP for 5 years. Your app shows you a return percentage, usually labeled as CAGR, or compound annual growth rate. But here's the catch. By definition, CAGR answers one specific question. If I invested a lump sum 5 years ago, and it grew at one steady rate every single year, what would that rate be? Now, do you see the problem? CAGR works perfectly for a lump sum investment, but it is terribly misleading for an SIP. Why? Because each 5,000 rupees installment was invested at a different time. Your very first installment has been growing for years, but your installment from last month has only been growing for 30 days. The honest measure for an SIP is called XIRR, which accounts for the exact date each and every payment was made, giving you your true annual return. Your app might proudly show you a 14% CAGR, but on a 5,000 rupees SIP over 5 years, your real XIRR could actually be 11.3%. This 2.7% gap might not sound like much, but over 10 to 20 years, that is several lakhs of real money, silently lost from your expected wealth. You can actually calculate this yourself in Google Sheets or Excel in about 2 minutes. Just list your payment dates in column A, your negative 5,000 monthly investments in column B, the current date and portfolio value in the last row, and then use the XIRR formula. So now that you know the difference between CAGR and XIRR, what do you actually do with this? First, when evaluating your SIP, always check XIRR. If your app only shows CAGR, use the Google Sheets method I just showed you. It takes 2 minutes. Second, when comparing two funds, compare their XIRR over at least 5 years. Not 1 year, not even 3. 5 years minimum, because markets go through full cycles in that time. A fund that looks brilliant over 1 year might have just gotten lucky with timing. Third, don't confuse the return percentage difference with the actual rupee impact. On paper, 12% and 14% sound almost identical. But look at the math for a 5,000 rupee SIP. Over 20 years, that tiny 2% gap is a 16 lakh rupees difference in your bank account. That's worth a car, a down payment, or a child's education. Do these 3 things, and you're already ahead of most investors in India. If you found this content helpful, hit subscribe and join our community. And before you go, what's your current monthly SIP amount? Let's talk in the comments below.